Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today, we're going to do something a little bit different on this channel. We're going to interview a highly successful private equity CEO, and yes, we'll get his economic and market outlook for 2025, but we'll also delve into his insights for achieving success in both life and business. Graham Weaver is the founder and managing partner of Alpine Investors, a people-driven private equity firm that invests in software and services businesses. He serves on the faculty at Stanford University's Graduate School of Business, where he teaches a top-rated strategic management course, and he's also a highly popular personal development influencer with millions of followers across social media. Now, Graham also happens to be one of my former business school classmates. I witnessed him begin his private equity firm from his dorm room there. He's a truly remarkable individual, and I predict you're going to highly enjoy today's discussion. Graham, thanks so much for joining us today.
Adam, thanks so much for having me. Looking forward to today's conversation.
Yeah, well, same here, Graham. And it was so great to see you at our reunion a few months back, and very much appreciate you making time out of your very busy schedule for this. Look, I want to ask you about kind of how you see the world as a private equity investor, and as I should add, a very successful private equity investor. But real quick, it might be fun just to give people a little bit of backstory about how you got started. I think of what Alpine is today, but I mean, I remember it's very scrappy. Pardon me, it's very scrappy origins. I remember you there in your dorm room, if I remember correctly, basically starting this thing when we were there at Stanford more years ago than I care to count. I think maybe you were even like financing initially some of your first deals like on credit cards and whatnot. So can you just give us a little backstory about what gave you the drive and really the focus back then at quite a young age to create it?
I worked, thanks, Adam. Yeah, I worked in private equity prior to business school, first at Morgan Stanley, and then at a small firm at the time. And the firm where I worked, the very first quote fund that they had, they didn't really have a fund. It was like they were what's called a fundless sponsor, which is they'd sign up deals first, and then they would go get the debt financing, and then they would go raise the equity. So they could buy companies with effectively no money, no fund. And so when I showed up at Stanford, I'm 25 years old, and business school is expensive, the tuition's expensive, but the opportunity cost of what you're giving up earning is really expensive.
Mm-hmm.
And so I sat down the first quarter and I started listening to someone teaching strategy kind of out of a textbook. And I remember thinking, I've got to like earn some money to pay for this school that I'm doing. And then I had this model that these folks on Wall Street had done where they, bought companies without having a fund. And so I started trying to replicate that. And as you could imagine, as a 25-year-old, I got like 60% of what they did,
Mm-hmm.
that I understood, and then a lot that I didn't, and a lot went wrong. But that was definitely the beginnings of Alpine. Yeah.
Well, so what was really interesting back then too, A, watching you go through this, and we were all super impressed because we were all still just drinking from the fire hose and trying to figure out what we might want to be when we grew up, and you were actually rolling up your sleeves and getting it done while we were there, during the school. And for folks watching who aren't familiar with business school, it's a short period of time. It's 2 years, it's basically 2 academic years in a summer. And Grant, you not only came up with the vision and the chutzpah to go do this, but I believe you bought your first company or bought into your first company during your first year there. And if I remember correctly, it was like a label making company. I mean, it was about as unsexy of a company as you could think of. But I remember you recruited some of our classmates to go like, consult and work, to try to start engineering a turnaround at this label making company in their summer. Is that correct?
Yeah, that's right. Yeah. I ended up buying the business during the winter of first year, financed
While
it
you were 24, 25 years old, right?
25. Yeah. I
Yeah.
financed it almost entirely with debt, a little bit of equity, which I also didn't have, which I borrowed some of which on credit cards. You could write yourself a check for $20,000, $30,000 and pay no interest for 6 or 12 months. and I did that. I do not recommend that to your listeners. And then yeah, I had a couple of classmates who went to this company, this small label printing company in Fort Wayne, Indiana, and it is a very unsexy business, and actually, like the unsexy businesses have been ironically a lot more. I've had a lot more success with those over even to this day than I had with the sexy ones. So it was a preview of things to come for
To
sure.
come. One of the reasons why I sort of underscored its unsexiness was when we were there at the GSB, the internet revolution exploded around us, right? I mean, we had classmates that were like worth hundreds of millions on paper, right, before they even graduated. And again, here you were going after, label making companies in the Midwest, right? And of course, your business became a sustainable success over time. And I know there were some challenges, which I want to talk to you about in a bit. But it's funny because I remember going back to one of our earlier reunions, Graham, and I won't mention the name, but we'd invited one of the more popular professors to come talk. And I was actually in charge of recruiting him to come talk. And I said, oh, we'd love to have you. We'll be in this room with all these people and we'll film it. And he said, oh, I'll come, but you can't film it. And he wouldn't explain why. And then when he showed up, the reason why he didn't want us to film it is he basically said, when I was there, we were all pretending we knew what this internet economy was. We had no clue. He's like, as far as I'm concerned, you should ask for your money back, right? Because we had no clue what we were teaching you when you were there. And I contrast that with you doing much more of kind of a, roll up your sleeves, just gumshoe type of true, investing versus the whole, eyeballs are going to change the world.
Yeah, the truth is, I felt kind of like the dumbest person in business school because I felt like I was the only one who didn't understand the internet revolution in it. And the way I would say it back then is, I mean, you would have companies that had a PowerPoint presentation and a URL address and would get funded. And I can remember extreme examples. This one company called Chemdex. It went public. I don't even know if it had revenue, and it had a $2-3 billion valuation. And I just remember not understanding it at all. And
Mhm.
and I remember one of my classmates, probably at that same reunion, you know, had been a little overserved and said, "Hey, Graham, during the greatest wealth creation of our generation, you're buying these stupid label printing companies." And I remember thinking, yeah, that's pretty much right. And not only that, it wasn't going that great. So it definitely was not me saying I'm smarter than everyone. I'm gonna go do this. It was more of me saying maybe I'm not as smart as everyone, and they all seem to know what they're doing. And as you said, I don't think anyone knew what they're doing. And there's a lot of parallels probably between that and uh, crypto, and I think AI is a little different, but there are definitely parallels between the internet and AI right now, which is the internet was life changing in ways that none of us ever could have predicted. And frankly, the internet was way bigger and more life changing and prevalent than any of us even dreamed about. And I think AI will be the same. And at the same time, some of the early models made no sense. And that's also true right now in AI. So I think it's a very analogous time to what's happening right now.
All right. Well, look, maybe we can dig into that a little bit, but let me now kick it up to a high level here, which is, we're now decades later. You've got a wonderful, very impressive track record of success. Your firm, has become the huge success that it is. As an investor, as you look at the economic landscape right now, what is your current assessment of the economy and the financial markets right now?
Well, keep in mind, I'm in the private market, which is
Hmm.
different than the public market. And the way I would distinguish a lot of times is the public market is always going to be the leading indicator because you can trade stocks minute by minute, and the private markets take a lot more time. The businesses don't move as quickly, the valuations don't change as quickly, and so there's a big disconnect right now. The public markets are ripping, and they've already factored in, I'm sure, rate cuts and AI productivity and a whole bunch of things that are getting people really excited about being in the public markets. The private markets are not there at all. The private markets are really clogged up. The reason for that is a lot of the businesses over the last X years have been purchased at multiples that you couldn't get today if you were to sell the companies. And the reason for that is largely really two things. One is there was a lot of demand pulled forward during COVID for a number of reasons. People working from home, people having stimulus checks, people building their inventories because the supply chain interruptions. And then, so the last 2 years, that's really come down. That's gone the other direction. That demand pull forward has meant less demand. The inventories have been, going down. So you have that.
Mhm.
And then the second one, which is obvious, is interest rates have gone up
Gone up.
significantly. I mean, not many times in history have interest rates gone up 500 basis points in, less than 2 years. So those are in the private markets, it's really still really quiet. I mean, the 2023, 24 were really quiet years in terms of M&A and deal volumes. Valuations have come down. So it's a tale of two worlds. As I said, the public market is the leading indicator. So I expect things to pick up in the private market, but it probably will still take a little bit of time.
Okay. And I'm going to ask this question because I discuss it all the time with all the other experts on this channel who do focus more on the public markets. Do you have any concerns about the levels of evaluations, sort of the extreme level evaluations that we're seeing in the public market, and that if they were to cause a correction, that could bleed over and dampen the public markets or the private markets further?
I think that the valuations in the public markets have not hit the valuations in the private market yet. So I don't think it would have an impact right now. But yeah, I mean, I think they're priced to perfection. So there's I mean, there are a whole bunch of ratios that you would probably even know better than I would, but on most of those ratios, the Shiller ratio or most PE indices, I mean, we're at we're almost as high as that market goes. Again,
Right.
not
The only other time the Schiller PE was where it is was when we were at college. The dot-com boom was going on.
yeah. So I'm not a macroeconomist. I would just say there's probably they're very very fully valued today. So
Okay.
it
Just to make
definitely
sure I understand,
what it calls.
when you say the private, that you can't you can't sell the private equity stakes for what they were bought for a few years ago. Is another way to restate that is people were paying insane prices a couple years ago?
Yeah, that is another way to say it, and that is just as
Okay.
accurate. Yeah. So you have a business that you purchased a big, a big, large public business, or sorry, private company that you bought X years ago. Let's just say you paid 15 times EBITDA, and now today you might get 12 for that same company. Then you might be at your investment horizon, but you're not going to sell it because
Mhm.
you're not going to you're maybe holding it higher than that, and you're not going to get those marks. So that multiplied across thousands of companies has really made for a very quiet M&A market for the last couple of years.
Okay. All right. And when you're in the private market, you're either counting on M&A at some point in time, or I guess going public at some point in time, right?
Yeah, and the IPO market's been quiet as well
Yeah.
yeah.
Yeah. Okay. Well, let me put this. I have a couple questions, but I guess the start here is okay. So you're there in your offices at Alpine. You're looking out at the landscape. You're thinking about what to do, for the firm's priorities for next year. Where does Alpine currently see the biggest opportunities right now?
I mean, in general, I would say our view is this kind of quote that Buffett has, which is if you're looking around the table and you're playing poker and you don't know who the patsy is, it's probably you.
Hmm.
And I think that's one of the most profound quotes about investing. So the question we're always asking ourselves is where do we have an edge? Where do we know something that other people don't know? Where do we have capabilities that we could do something that others couldn't do? And if we don't have that, we probably shouldn't be participating. So to answer your question, where we're looking for areas that where we do have that edge. And specifically for us, those tend to be smaller businesses that we're aggregating as part of a large platform and where we're putting in our own management teams because that is where we have an edge and we think we can transform those companies. And those, and then we also like to go in sectors that other people don't go into, kind of going all the way back to business school, unsexy sectors.
Mhm.
So we're in businesses like plumbing, HVAC, roofing, landscaping, IT services, home health care, revenue cycle management, security, locks, doors, boring stuff that doesn't lend itself to really high crazy multiples, or it lends itself to basic blocking and tackling and making the companies better.
Got it. Okay, so you're you're kind of like Mike Rowe and Dirty Jobs, right? You're kind of like the Mike Rowe of the private equity industry, right? Where you're looking for these kind of blue collar, trade oriented mom and pop service companies. Get in there. It sounds like you say you're buying the smaller businesses, but kind of with the intent of doing maybe like a roll up, like buying a bunch of.
The holy grail is, can we buy a business that's worth more to us than the person who's selling it to us? And that might sound like it's not that hard, but it actually is, because if someone founds a company, they've been running it for 30 years, they're running it efficiently, they've been doing it for a long time, and we're going to buy it from them. They know more about that business than we do. And we have to have some kind of playbook or expertise or edge or talent that we can provide to that company that's going to make it worth more to us than it is to that founder. And so it takes time to develop that expertise and to have those tools. And when and if we can have that, then that's when we can, roll up an industry, or go buy, businesses that where we think we can make them a lot better.
Okay. Um, do you, so when you're creating value like that, is it more on the um, strategy and operations end, where it's just like we just know how to operate this more efficiently than a guy who's been doing the same thing for 30 years and might have a smaller or, less professionally credentialed staff? Or is it really domain expertise? Do you like to say, look, we know something about this industry that this guy is just not applying?
It's operations. It's not domain expertise. The person who's been in the industry 30 years has lots of domain expertise. So it's going to be things like, we're going to have scale to do purchasing. We're going to have a whole team of people that do search engine optimization for marketing. We're going to spend more on marketing with our platform than that company had in revenue. We're going to be able to infuse the company with talent. We're going to be able to have training programs for those individuals. We're going to be able to purchase more cheaply than they could, because we're buying at scale. We're going to put in software systems that allow for better scheduling, better costing, and just more efficient operations. So it's that kind of stuff. It really is the gritty operational stuff, that we're embedding into those companies.
Okay. I was going to get to this question later because it's a little controversial, but I'm going to pull it up now in the conversation if it's all right with you, Graham, which is um, so I totally get the logic with that, right? We come in, we find this diamond in the rough, if you will, basically a company that we just know we can run more effectively than the current management. We hopefully pay them a nice check for the value they've created over their time, but then we bring that company to, a higher level, and then we enjoy the difference, right? And in business school, the holy grail was always trying to find these sort of sleeper niches that the general market had overlooked, but you could get in and you could do a big roll up in, car washes, whatever, label making. Um, so totally get that. Now, PE has got a mixed reputation. Um, and I've interviewed folks like Gretchen Morgensen, who's a Pulitzer Prize winning journalist, and I think her latest book is about kind of the evils of PE. And Gretchen herself will say it's painting with a broad brush, right? Tools can be used for good or evil. But there's the concern that PE can kind of hollow out industries where you get these suits, these MBA types like us, right, that come in and they find ways to maximize profits for the company, but they're like totally watering down quality of service. They're like, maybe reducing the staff to a skeleton crew. And then they leave a company that's got a much bigger debt structure and it just doesn't offer the quality that it did before. Um, I know you well enough, Graham, to know that that is not you and your values and your modus operandi. So, what would you say to people who have that concern about private equity?
I would say it's similar to saying, is journalism evil? Is public investing evil? Is sports evil? I mean, there's it is a broad brush to use your
Yeah.
terminology. Um, if you go through the history of private equity way back in the day, where it started was folks would do hostile takeovers of public companies, and it was hostile, quote, because the management didn't want the deal to happen. That's why it was, quote, hostile. But it actually was serving the shareholders because the management teams that way back when were having country club memberships and private jets, and they were basically
Right.
taking the shareholders' money and using it on themselves. And and so that was how private equity started, but it did have a real cost-cutting bent. It was, terminating large swaths of people, getting rid of, selling off assets. And that was how it started because that was actually what was needed for those companies, believe it or
Right.
not.
Those companies had a lot of bloat to
Yeah, they
cut.
had a lot of bloat and it was really hurting the shareholders. So early on, that was really the reputation of private equity. And I think there's still there are still firms that have playbooks that look like that, and where it's really heavy cost cutting. That really doesn't work. I mean, it works in the real short term. You can get a short term pop, but what you see happen is you kill innovation. You kill the company. A lot of times, you kill their culture. You kill their ability to recruit world class people, and I mean, if you're gonna flip a business in 18 months, maybe that can work, but I don't really see people doing that as much now, and I certainly I don't think it works, frankly. At least it doesn't work to try to build large companies and really increase the value of them and get outsized returns. I don't think that strategy it really works anymore because I think companies are already pretty efficient. And so what's much harder to do, and I think way more interesting and pays a lot better, is to get good old fashioned building companies. Hiring great folks, coming up with new incredible products and services, expanding geographically. That those are the plays that you can run and compound for years and even decades. And certainly that's where I think most of the industry probably is focused, certainly where we are focused, but there are still actors out there who implement cost cutting as a big part of their playbook, and that is detrimental. I think it's detrimental, typically again, painting with a broad brush. I think it's typically detrimental to the companies, and it's probably a smaller percentage of what the industry is now.
Okay. Okay. A couple things coming off of that. One, so, I've interviewed folks who are fixed income investors. I've interviewed folks who are real estate investors. And there's a percentage of them that take the approach of like, uh, okay, I'm building this portfolio of bonds, right? And the market value of those bonds may go up or may go down over time. I don't really look at that. I'm just looking at it as the income that it generates. And I'm just trying to build over time. This one guy has his framework called the income factory, this factory that just produces income. And I want it to produce more and more income as time goes on. I've heard people with their real estate portfolios say the same thing, which is, yes, I care ultimately at the end, at some future date about I've got more equity in this thing than I did when I started, but I really just care about the cash flow these things are kicking off. With your approach at Alpine, how much of it is, okay, I'm buying this company for X and I need to sell it for Y to be, to do what I have the returns I want to have here, versus I'm going to buy a company for X and it's going to kick off X amount in cash flow year over year that I'm hopefully growing over time. And yes, if we have a liquidity event at some point in the future, sure, that's great. It's in my model, but I'm really pretty happy if I just have a lot of great companies that are kicking off a lot of great cash flow.
Yeah, I mean, I think we are 100% cash flow investors, so we're paying multiples of cash flow when we're buying businesses. On a quarterly basis, that's what we're managing to. And the benefit of investing like that, whether it's your fixed income folks, real estate, or us, is you don't have a gun to your head to sell the things. You've got businesses that have intrinsic value to you. Frankly, I don't know another way to invest because I think if you're not investing for something that has intrinsic value for you to hold yourself, and in this case, it's cash that it's generating. It could be dividends from your fixed income stream, or it could be rent checks coming from real estate, but it has an intrinsic value to you. If you're not doing that, then you're really in the school of thought of the greater fool theory, which is you're buying something for the sole reason you think someone's going to pay you more for it
Mm-hmm.
in the future. And I think if you're being intellectually honest, there's a tremendous amount of investing that falls in the greater fool theory, and that's really dangerous. That's where you can really get crushed. You can do fine in the short term, but long term, it's a really dangerous place to play. And things like crypto or art or gold or things that have a really crazy valuation, like where you could never justify it as owning the cash flows. Those things all have some version of that, where you're really relying on what someone else is going to pay you for it in the future and not what it's worth to you in the present. And I think you want to, generally speaking, I've tried to stay away from those things in my investing career.
Okay. Well, and just none of those things that you just mentioned have cash flows. So
Right.
I
Right.
understand why they don't fit with how you look at the world. And Graham, you're going to have a much better assessment of this than myself. How when you describe your approach that way and contrast it to the greater fool, I mean, we know uh, we both live out here in the Bay Area. We know how Silicon Valley works. I mean, there are a lot of people, a lot of the VC community essentially is based on finding a greater fool, right? I buy this company, hopefully it's a rocket ship or whatever, but their plan is to offload it as quickly as possible for as much as possible, right? They're not looking to build a sustainable, profitable cash flow business the way that you are. Um, in the general area of private investing, are you are the majority of folks like you, or are you more in a minority?
I would say in my world, private equity, we're probably, I'd say more folks are focused on cash flow, but I'd also say there it's rare that people are really investing in a business to build a durable company that they could hold for a long period of time. So probably within this greater pool, there's a whole spectrum of, yes, I'm a cash flow investor, but I'm really going to try to ride some momentum or do some quick add-ons and dress it up a little and sell. So there's still a spectrum of where people are in terms of whether they're really trying to build a company for the long term and be happy holding it for that period of time. And I'd say we're on the extreme of that spectrum. And there's that has trade-offs too. That there's good and bad, but I definitely just feel more comfortable on that side of the spectrum.
Okay. All right. And I'm kind of getting the vibe, from my viewers, knowing them, that they're like, hey, look, to the extent I think private equity is a good thing, we need more like Graham Weavers in the world doing this. So, Graham, let me get to the fun part here of the conversation, which is really kind of what you've learned along the journey, because I know you've learned a lot yourself, growing this company, and I know that you are very focused on sharing what you've learned with the wider world, both through your class at Stanford, but also I mentioned very briefly in the intro, but I think folks should go Google you. I mean, you're a really big presence on a number of social media channels in terms of personal and professional development, and really trying to share, the best practices you've learned so that people can take them and hopefully achieve success in their lives. Um, Let me start this first with, so I know with Alpine, you had at least one moment where you were sort of staring into the abyss, right? Um, talk to me about, if you can summarize really briefly what happened, but talk to me what you learned through that process.
I wish it was one moment. We've had several that we were stared into the abyss, and I'll go through two in particular. One was the very beginning. We lost money on our first fund, and that should have been it. That that you do not want to be 25 and start a firm and lose money. Not a good formula. And the second one was we had as did a lot of people, had a really tough time in the recession in 2008, and we had a long time till we'd raised our next fund, and we had a number of companies that were really struggling. So I don't think I really ever connected these dots until much later. But my father, when he started a business, he's a veterinarian. He started a business when I was born, basically this almost the exact same time I was born. And I watched him take emergency calls in the middle of the night at 2 o'clock in the morning for 25 years and just build this thing brick by brick. And like, you could never point to one day that he made this great leap. It was just like little by little by little. And I remember him saying two things. He said, number one, it took way longer than he thought. So someone had told him it was going to take 10 years. He didn't believe that person. It took him like 15. So, and then number two is he built something much bigger than he ever thought. So both of those were true at the same time. And I remember him telling me that. And that was exactly my experience building Alpine. It took so much longer than I thought. I mean, there's not false humility, but probably it was not until you're 14 or 15 where I actually felt like comfortable that we were going to stay in business. And so it just took a long time to get there. And we built something much bigger than I ever imagined. And I think I mean, I learned a lot along the way, but maybe for your listeners, one of the biggest things you can learn is like, there's this huge lag between the work you're doing when no one's watching and the hard effort you're putting in. There's just a big lag between that and the results. The bigger thing you're trying to do, the bigger the task is, the bigger the dream, the bigger the lag. And you could see this, if you go to the gym and you start working out, and you might go 2 weeks before you see any change, or you might see a month before you really start to see it. And you might quit before that because you're like, this doesn't work. But if you stay with it, month after month, year after year, you can build a great physique, you can feel more healthy, stronger, et cetera. And that's been true at Alpine. Just multiply that timeline out instead of, months and years, we're talking years and decades.
Mhm.
So like we were just doing great work in the early period, getting the right talent in place, figuring out our strategy, building the right companies, learning intellectual property about how to build these small companies and applying that. We were doing all the right things, and it just took a long time until that starts to show up in the results of the companies, and then ultimately in the results of the funds, and then ultimately in the results of our franchise. It just takes it, but I think the biggest thing I learned is just how we were doing the right work, even in the fund we lost money. We were starting to really do the right work, but the results just had a real big lag effect.
Okay, interesting. As you're talking, I'm thinking the gym analogy is a good one, but thinking of like, we watch Steph Curry, sink a three-pointer in a clutch moment in a basketball game, and you think, what an amazing talent. And of course he is. But, in Steph's mind, he goes back to ages 8 through yesterday when he would go out there and shoot 300, three-pointers and just put in the time, right?
Yeah, it's like you and your show. You're recording shows, and you're just doing one show after another, and little by little you're gaining your audience, and over time that starts to add up. And when you look at it on paper, it looks like there's these huge, like for us at Alpine, it looks like there's these really huge asymptotic curves, but that's not really but the actual outcome, or the actual things that cause those asymptotes happened maybe even 5, 10 years earlier.
Yeah, we call it the flywheel effect, right? Where you crank, and sometimes the crank an awful lot of time before that flywheel starts to build momentum. But when it does, it's really beneficial. But you don't get that unless you're doing all that advanced cranking, right? All right, so uh, as an investor, what do you, I'm going to ask you basically the same question just for three different parties. In your mind, what makes a good or even a great investor? What are some of the key things that you've learned over time that whether someone's investing in a private company or a public company or whatever, but they're just sort of key tenets of investing success?
I'd say first is kind of have to know yourself, know what you're good at, know where your edge is, where your expertise is, and where it's not. Buffett says it doesn't matter how big your circle of competence is; it just matters that you know where it ends. And I
Mm.
think I think being really focused on areas where you can thrive. I have a really close friend. He pretty much the only thing he invests in is insurance. He's been doing it for 25 years. I think he's probably the best insurance investor in the country. And that's plenty. That's all he needs because he has an edge there and he sticks to that area. Um, we have an edge, which is building these lower tech businesses, often through integration, usually infusing the companies with talent. And when we can hammer that nail, things turn out really well. So I think on TV you see someone like Jim Cramer, who's so people are supposed to call in and be able to ask him about Nvidia and then Costco and then Amazon or whatever, and he's supposed to be an expert in all of them and be able to, and like that's just not how it really works.
Hmm.
Great investors know a few things really well, and they're going to know them better than everyone else. And over a course of a lifetime, you can compound those advantages dramatically by being focused. So again, going back to our example, I think we're probably one of the best in the world at doing add-on acquisitions. I mean, we know how to integrate IT systems. We know how to put in place the leadership teams, the talent, the training, the sourcing of add-ons, the purchasing synergies, blah, 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 all those things. And you compound your edge over time if you stay focused. So I think number one trait of a great investor is focus. Number two is and by the way, these aren't like super novel, but sometimes people don't need to learn something new. They need to be reminded of something that they might already know. So focus is number one. Number two for me would be time frame. I think time frame is a competitive weapon. Go watch CNBC for a day, and they're trying to predict what's going to happen today or tomorrow or this month, which, by the way, I don't think anyone can do. But
Hmm.
clearly, their audience doesn't care about what's going to happen to Costco over the next 2 decades. They want to know if Costco is going to hit its quarterly earnings, next Wednesday. And I just think I don't think that's a winnable game. I think so time horizon is just a massive advantage. You can build your own skills, you can build capabilities. If you're willing to invest in those things over a long period of time, you can take a long horizon for us, when we're building companies, we're going to hire the right people, put in place the right systems, because we know we're going to hold it for a long period of time. So I think if I had to just give you two traits, Adam, it would be focus and time frame. And I think you can do magical things just with those two traits.
All right. I think both of those are super valuable. And I've heard and lived the first one a lot, which is you know, uh, sort of play to your strengths. There was a school of thought out there which is no, shore up your weaknesses, and it's actually like no, like if you've got a superpower, you know, exploit it, right?
Absolutely. Agree
But you
100%.
gotta you gotta pair it with what it sounds like you've done a good job of, which is um, you then get to recruit talent to complement where you're not strong, right?
Right.
Yeah. So either that's a great staff
It's funny
that
because when we were building Alpine, I remember we did this exercise. We did it with a brown marker, so we called it Code Brown, but it was like we drew the entire functional leadership team and all the skills they needed to have, and then we each put in place in percentages where we wanted to play. This could be like sourcing, investing, compliance, finance, company building, boards, all those different things. And it was amazing because I thought everyone was going to put their X where I put mine, and they didn't. So for somebody who indexes really heavily in an area that you don't, that could be their code brown. That could be the thing they're excited about,
Right.
their strength and their superpower. So I agree with you. Don't spend too much time on your weaknesses. Now you might have some weaknesses that completely can take you out of the game. So one of the ones we see a lot is people aren't self-aware. They're not good listeners. They don't realize how they come across with other people,
Hmm.
and that will take them out of the game. So we want to provide them coaching, so they can make sure there aren't some like glaring terminal weaknesses, fatal weaknesses. But outside of that, I think, yeah, just play to your strengths.
Okay, so I just asked you, what are some attributes that makes a great investor? What are some attributes that makes a great entrepreneur? And there's probably some similarities and overlap, but it sounds like your company goes out and the important function is recruiting the right talent. What are some of the things you look at when you think of someone who's going to own a business, run a business, that are key?
Yeah, I'm still going to I won't reiterate the details of them, but I'd still keep focus and
Hmm.
long-term horizon on that list, for a CEO or a founder as well. I would add to that list a few things I've seen to be highly correlated. We have invested in over 600 entrepreneurs over 30 years. So I've had a lot of experience seeing which entrepreneurs were successful and why, and what traits they have in common. So the two I mentioned, focus and time frame, would be two. And then the other ones I would add to that would be the ability to recruit and build a world-class team, because founders a lot of times get to their success by being an individual contributor. Maybe they're a great coder, maybe they're great at selling, or maybe they design some product, or um, help get some drug through the approval process, whatever that is. But eventually, they're going to need to do it through people. So being able to build a world class team and hiring people that are better than you is very hard to do. But that would be on the list. Also on the list would be the ability to um, persist.
Hmm.
I mean, I just think great things take time, and I, I just don't know many examples of companies where it goes right away. I have students who start companies and I invest in from time to time, and it's sometimes maddening because they just quit after like a year. They're, yeah, I didn't get enough users, so we didn't think our model was right, so we wound it down. I'm like, you're probably 9 years from having those answers, So if you're not willing to stick with a business for a decade, I'd say don't start one. Because I think that you've got to have that willingness to stick through it and persist. If you do have that, I think you have a very high chance of being successful. I mean, some other traits we see: ability to sell. You got to sell everybody when you're an entrepreneur. You got to sell your investors. You got to sell employees. You got to sell customers, depending on what your business is. So that's huge. Ability to kind of move with high pace. You can't sit around thinking about stuff and analyzing it to death. You have to try stuff. Stuff's going to not work. So you can't really have this perfectionist mindset. You got to be willing to do stuff when you're 80% or 70% sure it's right. So those are a few of the traits I've seen that have been correlated with being successful.
All right. I'm chuckling as you say the last one because whenever somebody um, comes into my orbit, I kind of warn them and say, um, I'm like 20% strategist and 80% cowboy. Like, let's think it through enough to have an idea that sounds like it makes some sense, and then let's just start actually trying things out, right?
Absolutely. Yeah. You are going to learn way more doing it than you are thinking it to death.
Yeah. Yeah. And I mean, all your points are great. And, grit, that's the whole Alice Duckworth, research results, which is that's, in many ways, sort of the single greatest element for success in life, for anything, not just business. But to your point too about recruiting a world-class team, and we talked about leaning into the things that you're good at, but in business, and I'm sure you've seen this a lot, founders get founderitis, right? Where it's like a version of the Peter principle, right? They reach the point where they have brought the company where their own unique skills and talents can bring it, but to progress above that, they need to bring in the people who will catalyze that. And a lot of founders can't get out of their own way, right? They just mentally can't or emotionally can't give up the reins, and then they limit the company because they refuse to acknowledge, they were great, but what the company requires next is not in their, in their skill zone.
Yeah, that's right.
Yeah. All right. Well, then if we can, let's start kind of make the last section about I think probably the most universally applicable part of this discussion, which is success in life. Because again, I know a lot of I've seen a number of the things that you've had on the internet, the speeches that you've given on the internet that have a lot of great pearls of wisdom around this. I mean, the general question I want to ask is, how do you define life success, and what are the biggest lessons you try to impart to people? I guess I'll keep that open-ended, but if in your answer, if you can talk about this quote that I've heard you make a couple times, which is to live an asymmetric life.
Yeah. Yeah. So I'll answer the first one, and then I'll answer the second one. The first one more general, and the second one, asymmetric, was a little more prescriptive. I think the answer to the first question is going to sound a little woo-woo and a little spiritual, but I think that there's a part of us that knows where our real energy and passion and heart lies. And we know that at different times. It's not like when I'm 25, I know what that's going to be for the next 30 years. But when I'm 25, I know what that's going to be probably for the next few years. And I know the activities I've done that really give me energy and make me come alive. And when I coach my students at Stanford or Alpine, what I try to do is I try to sit down with them, and they'll come to me and they'll say, I've got 2 or 3 different job or careers or things I'm thinking about. And after asking them questions, I don't know, for 5 or 10 minutes, it's really clear which one gives them energy that they really want to do in their heart, not their head, but their heart.
Yeah.
And then what I try to do from there is have them realize that's the thing, and then help them to overcome the fears, doubts, and limiting beliefs, and that they're going to get in the way, and then also to create a plan to go do that thing. So to answer your question, what do I think makes success in a career, at least in your life, is doing something that you're excited about, that brings you energy, because you're going to be better at that than anyone else. Doesn't mean every day is going to be roses, but it means you're going to be more willing to persist, as we said before, which is I think the highest trait. You're going to show up differently. You're going to recruit people to go with you on that journey because you're excited. So I think getting yourself into that path of the thing you're most excited about, the thing you would do if you knew you wouldn't fail, I think is going to be a big part of the formula for having a successful life. The asymmetric life was me trying to distill down the 4 principles that I thought were most critical to having a really successful career in this case. And the 4 were, number 1, be willing to do hard things, because your life, when you want to do something new or get to the next plateau, it's almost always going to get worse first. So, if you're getting out of a bad relationship, you're going to have a breakup, you're going to be alone. Worse, if you're changing careers, you're going to not know what you want to do. You're not going to be good at it. You're going to have to learn a new skill. You're going to have to quit your job. It's going to get worse. Even if you want to start a new habit or go on a run or meditate, the initial move is going to be worse. So first rule is be prepared to do hard things, and then realize to get to where you want to go, you're almost always going to go down first. It's going to get worse first. Second one is do your thing. That was what I was just describing, which is find that thing that your heart's most intent on. The third one, which we've talked about already on this podcast, is, do it for decades. Be willing to really stick with it for a long period of time, and know that going in. And if you have picked the thing that you're excited about, you're more willing to stick with it. And if you're willing to do hard things, you're more willing to stick with it. So they kind of build on each other. And then the final one, which has been a huge one in my life, which kind of sits on top of everything, is write your story. Write the story that you want of your life. Like, sit down, write it today. You can't go back in time. So start today. Write the story you want to have for your life. Like, pretend you're writing a movie and you're the starring character. What do you want to be true? Like, what is that life you want? Describe what that looks like, and get clear on that. And I think, and spend however much time it's going to take you to do that. I've done this with executive coaches. Over the course of my life, I have probably 2 or 3 hours a week now I spend on that. And it's just, there's no amount of time on that that's too much to invest in, like, what is the life you want to live. And I think so many people just never really take the time to do that. And
Yeah.
the good news is, if you take the time to do that, I think you're halfway there. You're halfway to having that life by just describing in great detail what that life is.
Those are all excellent things. Thanks you so much for sharing. What's great about them is each plugs into things that I talk about on this program with a fair amount of frequency. Your last point there, I always liken it to, if you don't sit down first and determine where you want to go, if you just jump in your car and start driving around, the likelihood of you ending up at the best place for you is pretty low, right? It's that whole failure to plan is to plan to fail kind of thing, right? And I talk an awful lot in this channel about how our education system really fails us on teaching us financial literacy. And it's a travesty for a whole bunch of reasons. But when you ask people why do we value education? Why do we even go to school? It's sort of like, well, because I think it'll help me be better off, right? Well, what do you mean by better off? And most people think, well, I'll make more money as a result, right? And the fact that we don't teach people about money or financial literacy is crazy, right? Many other people might say, well, better off is living a life that's, the most fulfilling one for me. Great. School doesn't teach us about this either, right? None of the classes in schools are looking inward at ourselves, asking ourselves, hey, given all the information that's been thrown at us, how is this mapping to some trajectory that resonates to us in the way that you were talking about, Graham, right? So, in many ways, a lot of this is just making up for the failings of our education system. But yeah, if you don't do this stuff, how can you really expect to have the kind of success most of us aspire to if you don't put this kind of work in first? The only other plug I'll throw in here is number 2 on your list, do your thing. Finding kind of your authentic trajectory in life. Again, a lot of people feel stuck, like, I don't know, right?
Yeah.
And the younger you are, it can be hard because you have less life experience. One thing I'll just mention for people that you've heard me mention this channel before, a really good, so obviously if you can find a great mentor, a great executive or coach, they're pretty invaluable. And I can speak to that from my own experience as well as Grant sharing his. But if you're looking for kind of like a jumpstart, like a catalyst, the Johnson O'Connor aptitudes test, which I think many viewers here have heard me talk about, it's a great asset to people who are trying to, get some of that self-understanding in a very quick period of time. And I won't go into depth on it now, but hopefully folks, you've heard me talk about it before, or you can just Google it and read about it online. All right, Graham, look, we're coming to the end of the hour. This has been a wonderful conversation. Thank you so much for sharing all of this. I know you don't, you're unlike a lot of the people that I interview who have a newsletter or a book or stuff like that. But for folks that have really enjoyed getting to know you through this conversation, would like to follow you and your work, maybe get exposure to some of the development content that you put out there in the world, where should they go?
So I write a blog, and I have a lot of my content on my website, grahamweaver.com. So that has a number of the videos, speeches on that, and on my blog. I'm on YouTube. I'm Graham Weaver, or Graham C. Weaver. I have a channel, and then there's two speeches. One you referenced, How to Live an Asymmetric Life on YouTube, and um, the other one is How to Live Your Life at Full Power. Those are both on YouTube, and then I'm on TikTok and Instagram, Graham C. Weaver, and I'm on LinkedIn for my name, Graham Weaver. So I'm on kind of all those platforms.
All right, and Graham, I'll put the URLs to as many of those as I can up on the screen when I edit this, but I'll also put links to them all in the description below this video. So folks, if you want to go check out any of those assets, and I highly recommend you do, especially the videos Graham referenced, the links will be in the description below this video. Graham, thanks so much. Folks, if you really enjoyed having Graham on here, would like to see him come on again in the future, please let him know by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Obviously, if you want some help navigating the future from a financial standpoint, feel free to schedule a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there. As a reminder, those consultations are totally free. There's no commitment to work with these firms, just a free public service they offer. While you're there at Thoughtful Money, hit the newsletter link at the top of the page to sign up for our free newsletter if you haven't yet. And if you're a free newsletter subscriber and have been thinking about upgrading to premium, upgrade now if you can. Graham, real quick, my friend, again, this has been wonderful. Any parting bits of advice for the viewers of this channel, especially as they, we turn the calendar into a new year and maybe they're inspired from this talk to work on becoming more of the better versions of themselves next year?
Yeah, I would say the last thing I said about writing your story or living with intention, it's the highest returning investment you're going to make. So take out your calendar. You're really, if you want to know where your life is and your commitments, look at your calendar. So pull out your phone and put an hour a week on your calendar, make it a standing meeting for the rest of your life, really. And during that hour, just be asking yourself, what's the life I want to live? What matters to me? What's the story I want to write? And literally I'd spend at least an hour on that every week and get clear on that, and then start scheduling the priorities to make that life come true into your calendar as well. So that habit will change your life more than any other habit that I know. So hopefully that'll be helpful.
All right. And, I'll just underscore, Graham, for the folks that don't know you the way that I do, nationally accomplished athlete, ferociously successful businessman, the fact that you're saying, hey, look, this is the highest ROI use of your or anyone's time, folks should really take that to heart. Graham, it's been wonderful, my friend. Thanks so much for doing this.
Thanks, Adam. Thanks for having me.
Everybody else, thanks so much for watching.